Here we go. We're recording. I don't really have a preemptive intro. I'm excited to hear what you have to say. The market's a little bit crazy. So I think we all want to know what's in your crystal ball today. And
Yep.
I just want to throw out that I'm working with a lot of agents that obviously are concerned about this next year and wanting to do some more prospecting and marketing and branding and all that stuff. So if you want to get some help, get a jump start on anything, I would love to sit down with any of you guys and go over plans for the next year. If I'm your sales executive, if not, give your sales executive affiliate a call. So Katrina, Riley, Kelly, Heidi, Annalise, I'm probably forgetting someone, but give them a call and that's what we do. So we're here for you.
Don't give Cinda a call anymore.
Yeah.
Oh, yeah.
All right. Yeah. Thanks again for doing this class, Walt. There's always a good nugget in here.
Yeah. Well, thanks for having me, and thanks for for hosting the class and that. It's, I always enjoy these classes. It not only I find that I get a lot out of it as well. And so it's one of those things where I think the teacher probably gets more than what the class gets a lot.
Well, you have to do all your research before you teach it to us. So
yeah. And
which we appreciate because we don't want to do that part.
And I find right now, just to go back to what you had just said, Tracy, what I'm finding right now, the economists and that I listen to on the mortgage side, and it's going to filter through on the realtor side. They're all saying right now is the time to work on your systems, work on your branding, work on those things, because we all have a little more time right now than what we did just 6 months ago. So now's the time to do that, because it's coming back. Rates are going to go down again, and the housing market's going to get super crazy again. And we've got, who knows how long? I mean, 6 months, a year and a half. We don't know exactly.
There will be some pent up demand for sure.
Yep. So yeah. So it's actually for me, it's an exciting time for my team. We're working on our systems right now and working on dialing in a few more things. Various drip campaigns that we have for various folks in that, and I'm trying to revamp those and make them even a little bit better. So yeah. So thanks for having me, and should we just get rolling now at this point?
Let's get rolling. Yeah.
All right.
Yeah.
Beautiful.
And
So
I'll be issuing the certificates. They'll be going out this afternoon. So for everybody on here, it'll be coming in your email. So reach out if you don't get it for some reason.
Perfect. Thanks, Tracy. And then we do have, I've got Susan Dunphy as well. She is in the attendees, so you won't see her here on the screen with us, but she'll be able to answer some questions and things. And so if you, I think she mentioned she can see the chat. So if you have some questions and you want to pop it in the chat, let me see here. I think it was the chat. So anyway, pop them in there. If it's in the Q&A section, Tracy, if you can just let me know, because as soon as I pop my PowerPoint on, then I can't see anybody.
Okay. I guess one more housekeeping bit is I'm issuing all the CEs. So I'm going through and looking at the attendees, and I see like there's some people that just have their first name, or they may just have their phone number. So you'll want to go in and change your name so I know who you are, so I can give you credit.
Yep. And I'll send you a full roster of everybody and time frame that they were in. So
okay.
Perfect. All right, guys. Well, let me share my screen, and then let me pull up my slide deck. And go from the beginning. So you guys should see my slide deck here. Is that right, Tracy? Everybody else?
We can see it.
Perfect. Okay. So 2 biggest questions on every agent's mind. I have physically taken the time to read every agent's mind out there and find out what the 2 biggest questions are. Just joking. But first, what I want to talk about before I get into that realm is really, move this here because that is in my way. There we go. I want to talk a little bit about what our clients are really starving for, and what I'm finding a lot of you are starving for, and really what the industry and what people around us are starving for. I'm reminded back this morning, I watched Barry Habib, which is a economist that I watch every day, and he helps really to put down into good information as to what the bond market's doing and news that's coming out and things like that. So I pull a lot of my information from Barry and from a lot of other places, Keeping Current Matters, and places that I'm able to give you good, correct information. And this is a for instance, that I want to share with you of really the media being in the gray area, not really being one area or the other where they're giving correct information. They're not really not giving correct information, but they're not wording things correctly. And so why I want to share this with you is because one thing that Barry talked about this morning was he remembers back to Mark Zuckerberg when he's being interviewed by Congress, Senate, whatever, when he was being interviewed by them, and a senator had asked him, what does Facebook do? And he'd been kind of hounding Mark on that question. What does Facebook do? What does Facebook do? And then Mark finally just fires out, we're in the advertising business. And that's really what Facebook does. They advertise. And so they do that all throughout our feeds. We're advertising to each other. I mean, it's a big advertising business. So what Barry talked about was that's really what the media does as well. I mean, isn't it? The media is advertising for space. They are trying to get, for better sake of the word, buy enough brain cells out there of people watching them that then they can share their information. Fortune magazine, there was an article written by Lance Lambert on the 11th that says something big is happening in the housing market, which that's a big headline, right? And then he goes on to say, this softening is by design. The Federal Reserve is done watching inflation run away and has made it a priority to cool down one of its biggest drivers, the housing market. To do so over the past few months, the Fed has put upward pressure on mortgage rates. That statement is completely incorrect. So the Fed has no direct correlation on what happens with mortgage rates. They don't do anything with mortgage rates. So it's up to us then to educate our clients and those that we're around, to educate them on what's the truth behind it. What does the Fed do? The reality is that the Fed did not get a hold of inflation quick enough. And we'll talk more about this here in a little bit, but the Fed has one thing to do, and that is kill inflation. That's their whole job, to kill inflation. They printed a lot of money. I forget the total numbers. It was like 30 or 40% of the money that we have in the nation right now was printed in the last 2 years, which is insane. That's what has led to our inflation. And the Fed is raising the Fed funds rate, which is the overnight cost of funds that banks charge each other for money when they borrow money from each other. And there's 5 banks in the US that can go directly to the Fed and borrow money. And so it's the rate at which the banks charge each other for funds, but then also those 5 banks can borrow money from the Fed. So that money then goes into home equity lines of credit, personal lines of credit, auto loans, credit cards, things like that. So as they're raising the Fed funds rate, they are raising all of our credit card interest rates, home equity lines of credit rates, auto loans, all of that. They're doing that to slow spending down, because theoretically, if we have higher interest rates, then with that, then we're not going to spend as much money. That's the theory behind it. So as the Fed raises the Fed funds rate, that then sends a message to the stock market and the bond market, one way or the other. And we've seen an increase in the bond or in the stock market over the last 6 months because the Fed has been saying there's inflation in the market. Well, companies have a tendency to do better with inflation because they have a tendency to make more money. where, you know, the bond market does not do very well with inflation. In fact, inflation is a killer on bonds. We've seen that. And so we have a massive sell-off in the bond market. And right now we have something very unique going on where we have money from the bond market that normally would go to the stock market or to gold and silver commodities. But now we have money going not only there, but also into crypto. So into Bitcoin and a lot of other areas. So it's very interesting to watch. But again, this is an article where Lance is not being completely correct. He's just kind of touching upon, you know, what the Fed has an indirect portion on, but not a direct. So again, the Fed has put upward pressure on mortgage rates. That's not correct. So it's very important that we share the news out there and what is correct. Also, let's go. So this was, I thought this slide was later on, but this is when the Fed back in November started changing their news on inflation and started talking about it being, instead of transitory, and you know, it's prevalent in the market. And so so they changed their verbiage from transitory to prevalent in the market. And when they did that, you can see that immediately, because the Fed was not raising the Fed funds rate at that point, they were holding off and holding off. We then fell pretty considerably in the bond market. And then also when the Fed met back in May, they were supposed to raise the Fed funds rate by a half. They did not do that. They raised it by a quarter. And again, we had a big sell-off in the market because the bond market likes certainty. That's what the bond market wants. They want certainty. And when the Fed is not being certain on what they're doing, they're not being tight on inflation, and that then there's going to be a sell-off in the bond market. And we've seen that throughout this period of time. So again, that's where we are. And then here I shared this in our last class, but our friend here, Diana Orlick, that is a commentator for CNBC, she is one of the masters out there at really not giving correct information. So this, she had said nearly 50% of homes considered overvalued. This was in 2017. So had you followed her advice, kind of like Dave Ramsey, if you follow his advice 100%, you're not going to get what you want. And so, you know, Dave Ramsey has a lot of good things. Diana Orlick has a lot of good things, but this is one of those times where Diana Orlick has been completely wrong. The other thing where Diana Orlick has been completely wrong is that she's been talking about 7% interest rates. She's saying right now a first-time home buyer is going to get a 7% interest rate. That's not correct. It's up to us to then share the correct information. So here, put this in perspective. Diana had mentioned nearly 50% of homes considered overvalued, and that was in the US. 2017, the average home, I want to say at that time when you know, I would say probably our purchase prices were around 300-ish in that ballpark. And so not the average, but let's just say that you bought a home around 300,000. That home now is probably worth about 475, 500, right? So you would have lost out on, you know, a good $150,000, $200,000 worth of equity had you not purchased that home in 2017 and had you listened. These are the individuals that are sharing that there's a housing bubble where there really is not. It's a supply and demand issue. And so, so help really with us in sharing correct information. There's so much noise out there, and there's so much ability to be able to share noise out there. Let's share correct information. Let's make sure that we have good information from reliable sources as we're sharing it. So the things that I share on my Facebook page have been vetted multiple times. I know they're correct. I know they're good. It's good information. So you can always check out my Facebook page, just Walt Schultz, and you can always pull information on there if you want to share with others. So today we're going to talk about how will rising interest rates affect the real estate market? When will we see more inventory hitting the market? So really those are the two main questions, right? How are rising interest rates going to affect? And then when are we going to see more inventory? We're also going to go into, is now a good time to pay cash for a house? And then with a rising or with using a reverse mortgage, how can we create wealth? So let's start getting through these. So here is a slide chart from Gotta move my slide here thing again. Can I put that? Okay. So this was from Freddie Mac. And at that time, rates had gone really from the national rate around 3.1 all the way up to, this was about a month ago, at 5%. Now we know that it's gone higher since then, depending upon clients. I know yesterday with a specific client, and actually it was a fictitious client. I'll show you the TCA here in a little bit, but with a particular scenario, we were at 5.375 with that client yesterday. But I know that a lot of times we're around 5.5, 5.75 for clients, and that if you have really tougher credit, lower credit scores, and you're going conventional, you're going to be into the sixes pretty easily. That's why a lot of times conventional, we're going to flip to FHA to be able to help give them a little bit better rate. The other thing is that if you have lower credit scores on conventional, and when I say lower credit scores, I mean, I'm talking like 700, 720 and below, you're going to get hit with a higher interest rate, and you're going to hit with higher mortgage insurance. So again, that's why it's really a lot of times more important to switch them to FHA, to where interest rate won't be hit as hard, and then the mortgage insurance won't be hit as hard. So we know that rates have been rising as we've all been in the business here recently. All right. So chief economist for Freddie Mac had said mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate. I think that's the most important thing right there. So we've really been through the worst of it at this point. Now the pace at which we're going to increase rates will be at a slower pace than what we have done here. Again, showing, I mean, just since December, we've gone from about a 3% rate on up to a 5+% rate. So a 2% increase in interest rate, which is pretty significant. So he's anticipating it's going to be slower going forward with the increase of interest rate. Much of the increase in the rates in early 2022 is anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. So again, the Fed has one job, and that is to kill inflation. If they start talking about a 50% increase in the Fed funds rate, a 50 basis point increase in the Fed funds rate, then they need to follow through with that. But they can't talk about a 50 basis point increase, which is perceived as being strong on inflation and trying to kill that inflation, and come back with a 25 basis point increase. They've got to do what they say they're going to do. And that's really where they messed up there in March. I will say that, I mean, the Fed has a tough job. They have a really, really tough job, and they've got to make sure that they raise the Fed funds rate, and that they keep us in a good, strong economic view, and a good policy where they don't slide us into deflation or stagflation. But I will tell you that the reason why the economists right now are saying for our industries, now's the time to work on your systems, is because as the Fed is raising the Fed funds rate, they are pushing us into a recession. So a recession has been more news in the news than as of late than before. And they're going to push us into a recession. As they push us into a recession, that's going to cause interest rates then to go down. That's happened every time we've had a recession since 1942. So interest rates will be going down. Now I'm hearing, and this is just hearing, I don't have any proof behind it, but they're talking about potentially interest rates being back down to that 2.5–3% level, and possibly even a little bit below. So again, now's the time to work on your systems. So here's the impact of rising interest rates on home prices. And this is every time that interest rates have risen more than a full percent since 1993. Now, I got in the business in 1998, so I remember actually when rates started going up in 1998. I'd gotten in the business in February, and I thought our business was dead, was over in 1998 when rates really started to climb. and we had good interest rates, and then all of a sudden, just overnight, they climbed up. I also remember June of 2003. I remember July of 2003. Interest rates went up by, it was about a half to 3/4 while I was on vacation. And so I remember that vacation. I was in Mexico at the time. So I can kind of go back and I remember what had happened during these times. But more importantly than that, what I wanted to show you guys, not necessarily my stories, but what I wanted to show you guys was really what happened to home prices during those times. Now, kind of the conventional wisdom would be that if interest rates rise, then home prices really should decrease. And that's what some of the media is saying. But that really isn't the case. That isn't the truth. So here we're looking back in 2000 or 1993. I mean, home prices went up still 3%. Home prices went up as we had an increase, and we had a 2% increase in 1993. And so in 1996, we had a 1.2% increase, but still home prices went up by 2%. In 1998, we went up by 13%, 2003, 13%, 2005, 7%, and then 2011, 11%. So during that period of time, we had an increase, even though the interest rate had been increased by more than 1%, we had an increase in home prices. That's something really interesting to watch. Now, as we look at the impact of rising rates on home prices, here we're going to look at the mixed impact on rising rates on housing. This is specifically on home sales. Now, if you go back to 1993, as we had an increase of 2.38% in the increase of interest rate, even though home prices went up, sales went down by 11%. We keep going down, 96, they went down 2%, 98, down 2%, 2003, they went up 2%, 2005, they went down 14%. And I'll tell you that is really, in 2005, that's when we started hitting the Great Recession in 2008. This started happening back east first. And I was there as it was starting to happen, where house prices just started plummeting. The other thing is that as house prices start to plummet, then rents also go up as well. So here we have 2012, again, a decrease of 2%. So you might say, well, I mean, that's a average of 11% of a decrease in home sales. And so, however, if you listen to National Association of Realtors and others, they're all stating that really home sales are supposed to be higher this year than they have in the past. So what I'd like to do is first, as we talk about this, really look at, again, the increase here, as we've got an increase, a 2% increase. Interest rates went all the way to 9% in 1993. Now that's pretty significant movement, but it went up 2.3%. So really that means that interest rates were in the high 6s, low 7s for them to hit 9.2. As we look at other interest rates, the reality and the economists I'm listening to, I don't hear anybody saying that interest rates are going to go to 9%. So as we look at that, really, I say, well, I don't know if that's really a good representation of the market that we're in. So, let's really just slide through that. Let's then look through 2005 to 2006. Again, we're starting into the Great Recession at that time. And during the Great Recession, what's interesting about that is that the Great Recession actually was already slated to happen. And it is a market movement that happens every 40 years. It just happened to be the housing market that put us in there, the mortgage arena that put us in there. But it was already slated to happen. It was just what was going to set off that chain to happen. But it is a market that happens literally every 40 years. And so if we slide through both of those, a market that happens every 40 years and a very high interest rate, then we're really looking at -2%, -2%, +2, and -2. So really a very negligible amount of increase or decrease. So I slide more towards what NAR says and some other economists, really, that housing sales should be the same, if not higher, than they were last year. So housing purchases should be strong. They should be strong. Now, this was the director of forecasting for NAR. And Nadia went on to say, while higher short-term interest rates will push up mortgage rates, that's the Fed increasing the Fed funds rate, I expect some of this impact to be mitigated eventually through lower inflation. Thus, I expect the 30-year fixed mortgage rate to continue to rise, just like we're talking about, although we aren't likely to see the big jumps that occurred over the past few weeks. So again, we're not going to see the big jumps that we have. I think really we're kind of capping out around where we are right now. We're going to go up a little bit more, and maybe we hit into the sixes, maybe we're at 6.5. But then as we start to hit that lower inflation side, and as we hit into a recession, then the tables are going to turn, and then we're going to start to have a little bit lower interest rates. So when we look at really home price forecasts, the biggest question is, are we in a bubble? Is it going to burst? Are home prices going to decelerate? And we look at really CoreLogic. They're one of the main people that I have a tendency to watch. They've changed their forecast a couple of times this year already, and they're stating that really we're going to see about a 9.6% appreciation this year. Whenever we're talking to clients, we always work on numbers of around 5 to 6%. But as we look at everybody here, the average really is 6.7% between the different individuals that are doing their forecasts. But I think really just if it was me, and what I'm telling my clients is, I'm thinking really that we're going to have really a forecast of around 8 to 10% this year. I think that the prices are going to rise about 8 to 10% this year. So we're in that ballpark there. Freddie Mac said, history suggests that when rates rise, there's an initial bump in home prices as many move quickly to buy a home before rates increase further. So we're going to see that. And that's why we're going to see that little higher appreciation this year than not as high as some people are thinking. But after that period, home prices slow. Freddie Mac analyst shows that a 1% increase in mortgage rates results in a home price appreciation that is 4% lower. For instance, 1% increase in mortgage rates could change home price growth from 11% down to 7%. And if you remember at the start of the year, we were really looking for a home appreciation rate of around 12% this year. Last year, we had 17.2%. And as we've seen those increases, then we're down. So really, when will we see more inventory hitting the market? And as we look at that, we look really first at a change in inventory. And this was from Realtor.com for the first quarter of the year. You can see that really our change in inventory was pretty insignificant. I mean, it's 0.7%. So I'm sorry, this was not from the first quarter. This was from January to February of 2022. Sorry. So we saw really a change in inventory of about 0.7%. Now, as we look at really a change in inventory between February and March, we then see that we had a 7.9% inventory change. Now, that is pretty significant. That means that we had more homes starting to hit the market in March, which is really starting to look very good. As we look at really since January, again, Realtor.com numbers are showing that the amount of listings that are hitting the market are starting to increase. And they've been increasing for the last 3 months. So every month they keep increasing. And this is in new monthly listing counts in thousands. So 326,000, 370, and 434. So again, if you look though, just a year ago, we're really almost in the same market that we were just a year ago, where COVID was a little more prevalent. So, so that's also very positive, where we're starting to have more homes hit the market. But really, I don't think that we've backed away really fully from COVID at this point yet. When you're looking at new listing counts in thousands here again, you're looking at the previous 2021, you can see that we're higher for the new listing counts over the months there, which is very positive. Again, new monthly listing. So this here is this line, this thick green line is 2021. And then we have this really squiggly line here, the orange line, which is, I guess they're all squiggly, aren't they? Is in 2020. Of course, when COVID hit, new monthly listing counts really plummeted, and then they started to increase again. However, when you look at really the main line of 2017, 18, and 19, where we're headed right now in 2022, it looks like really that we're heading along the path of where we were in 17, 18, and 19. And really, as soon as we get our April numbers, we're going to know. But it looks like that we're following that path. And that's the path that I would anticipate that we follow, where we really start to hit more and more listings as we're hitting the market up until about June-ish or so. And then we start selling those listings off. And then we head into the fall market and into the winter market, which again, historically, we always have less listings during that period of time. So right now is really a great time to list your house. Really a great time to help your clients understand these things. So as we look at active listings, and they've increased for the first time in 6 months. So that would be active listings. And here's where we're showing those. As we look at new listings greater than active listings, this is really again the first time that we've had new listings greater than active listings, meaning that we're starting to get more listings than we're selling on a month-to-month basis. That's going to help out our market. So we're not outpacing the market in how many listings that we're getting. So again, a great time to put your house up for sale. We're certainly not getting to a buyer's market anytime soon. We understand that listings and that real estate is a supply and demand issue. We understand that really the supply right now doesn't meet the demand anywhere close to meeting the demand. And if you guys all understand where that demand's coming from, which I think I've shared that with you guys in the past, and that is it's really coming from the millennials at this point. The first-time home buyer, the average first-time home buyer is 31 years old, so they're a millennial, and they're purchasing homes. And we have more millennials for the next 5 years hitting the market than ever before. So we have more millennials hitting 31 years old for the next 5 years than ever before. So anybody that says, hey, there's a housing bubble, just share that statistic with them. Have them look it up on Google. There's more millennials hitting the market than ever before for the next 5 years. So that means, and also builders can't build houses fast enough right now, as we know that as well. And so it's very interesting because you've got the millennials hitting the market trying to buy houses, that's pushing the house values up. And as that's happening, builders are now starting to try to build, but they're not able to build fast enough. And I saw a report that looks like about 5 years from now, they'll start to get caught up, but it's really going to take them 10 years. So that could mean that the supply and demand issues that we're having right now, we could definitely have for the next 5 years, but potentially we could have for the next 10 years. So it's going to be a very interesting market for us moving forward. And market that a lot of us have never seen. So, as we go into, really is now a good time to pay cash for a house. And let me first just see here if we have any questions. I see any questions in the chat. Okay. All right. So it looks like everybody's been answering the questions. Okay, cool. So we'll start talking about, is now a good time to pay cash for a house? As we know, as we're heading into inflation, as we're in an inflationary market, cash is not a good thing to have just sitting out. And so you want to invest it in some sort of an asset. And housing is always a good asset because housing acts as a hedge against inflation. So let me talk to you a little bit about Elon Musk and how he purchased Twitter. I don't know if you guys caught this. It really isn't being talked about a great deal. And Elon Musk, one of the richest people in the world, really showed us leverage and really showed us how the rich have a tendency to do things. And so if we want to emulate the rich per se, then we should do more of what they do, right? So this was an article in Forbes, and here it says Musk assembled 46.5 billion to fund his Twitter takeover, which is with his own assets backing 2/3 of that amount. Musk's portion includes a giant 12.5 billion margin loan secured by his equity stake in Tesla. The remainder comes from bank financing secured by Twitter's own assets, a classic leverage buyout arrangement. So, so here you've got, he's leveraging part of his Twitter stock. Literally, he did not put $1 of his own money towards this purchase. He took a bank loan on his Twitter stock, and then he took a loan out against Twitter's assets. And I was asked by an individual, well, how can he do that when he didn't own Twitter? It's the same concept of buying a house. You know, you are taking a loan out against that house. And so he was taking a loan out against Twitter because he was going to own Twitter. And so he was able to take a loan out against Twitter stock that he was going to own, and then the stock that he owned at Tesla. So, and here, as Forbes says, a classic leverage buyout arrangement. So I think that we can really start to look at this and understand that if the rich is doing this and if they're leveraging, then it might be wise for us to look at leveraging our cash, not keep cash in the bank. Cash is not always king, but have it there to be able to help us when the time arises. So let me just walk through a couple scenarios with you guys real quick and see if cash is really a best option to buy a house. So if a client comes to you and if they're paying cash, understand that cash has two things. It has opportunity cost and it has employment cost. So if it's employed in a house, let's just say, then it's missing its opportunity cost. And so, but that opportunity cost can be pretty significant in another form. Let me explain. So paying cash for a house, if you pay cash for a house, $450,000, your payment, you're still going to have your taxes and insurance payment. That's going to be roughly $500. So $450 a month for taxes, $50 a month for homeowners insurance. If you took out a loan and you did more of what Elon Musk did, you're looking at, and this was the 5.375 I was talking about, when I went through this yesterday. Take out a loan at 3.375. I'm sorry, take out a loan at $337,500. Rate is 5.375. Your payment, including taxes and insurance, will be roughly $2,389. So you've got an opportunity to be able to do that. Then the question is what do you do with that $337,000, and how can you make it employed? So, how make sure that you're not missing an opportunity with it. Now, banks do something, it's called arbitrage. And what banks do is they'll borrow money from us in our savings accounts at 0.5% per year, or whatever that may be. And then they'll turn around and they'll lend that money out on personal lines of credit, home micro lines of credit, and auto loans. And they may charge you 5, 6, 7%, and higher now because the Fed funds rate's higher. And so, but that's what they lend the money out on. And that difference is called arbitrage. So the question is what do you do with that extra 337,500? Do you dump it into an investment? Do you, put it into an investment in one lump sum? Or do you take payments? Do you pay cash, tie it up in the equity of your house, and then pay cash on a monthly basis because you don't have a mortgage payment? What's the wisest decision to do? So the principal and interest payment on 400 or on 330 or 337,000 is $1,189. So these are the actual payments here and the payment breakdown. So really the question here is, and what I want to drive forth on this is how we counsel our clients. And we share compound interest with our clients, and we share really more mortgage planning strategies with our clients than just helping our clients get a loan. And so if a client is looking at paying cash for a house, I'm going to ask you guys to challenge them to say, why are you paying cash for a house? Now, because literally it can be a massive mistake for them to do that. If they're paying cash for a house, I know it's a little bit easier of a transaction. And we've got ways to be able to help our offers be close to cash, where we pre-underwrite all of our approvals. So they're fully underwritten approvals, not pre-approvals to the industry standard. But, for that client, that could be a bad thing, on if they're paying cash. If they just say, I just don't want a mortgage payment, I sleep better without a mortgage payment, then certainly they need to pay cash for the house. And there's some people that really should pay cash for a house. But if we can help them look at more of an investment strategy, that might help them long term. So what I wanted to show you here is that if they paid cash and then they said, I'm going to invest the rest. So I'm going to take my $800 or $1,889 a month, put it into an account, making an 8% return. Now, your question might be, where do you get an 8% return? Well, I will state that the S&P has averaged 10% for the last 30 years. So you can just invest in the S&P. But I'm not a financial planner. Talk to a financial planner. So if you wanted to invest in an 8% return, and if you invested $1,889 a month over a 30-year span, you'll grow an account at $2.815 million. So you pay cash for the house, you take the monthly and invest it. That's what they say they want to do. Or you take one lump sum. And this is where one lump sum is much more important. And I want to share with you guys really the rule of 72 compound interest. Albert Einstein said that compound interest is the eighth wonder of the world. And it really is when you look at these numbers. You take one lump sum and invest it at an 8% return over that same 30 years, right here, that lump sum grows to $3.69 million. It's basically $3.7 million. They make $875,000 more. Now, that's if they were to invest one lump sum. Imagine if they were to take that and purchase two more houses. So if they were able to purchase two more houses, they could put 50% down or 40% down on a house, and they can have them cash flow. I mean, those houses over that period of time, are they going to go up by more than 8%? They could. So that could be a great option there to help your clients understand, really leverage, the way that Elon Musk did leverage. And so this is also a great opportunity to be able to work with a financial planner if your client doesn't want to purchase more homes, but maybe they want to invest with the financial planner. You've got a referral to a financial planner, and at anything over $250,000, most financial planners want to work with you because they're a accredited investor. So, so most financial planners can work with you on that. So that would be pretty significant. Again, I mean, over 30 years, that client makes $3.7 million, or on a monthly basis, if they invest over that 30 years, they make 2.8. that again is the idea of you want to invest earlier than later. But if you can invest one lump sum over monthly payments, you'll come out ahead significantly. So again, net worth, they pay cash for the house, they get a loan, pay it off. What do they do with the savings? They reinvest. So they either invest on a monthly basis, the 1,800, they end up with a total net worth of 4.7 million. That would be the home equity plus the money that they have in their investment, or one lump sum investment at home equity, and then the investment that they made from that roughly 3.7 million. So they have a net worth of 5.6 million. So this is really following a safer path for the client. The other thing is that let's just say that through the process, as if we're following a safety, liquidity, and a rate of return test, which is what financial planners will follow. If we're following that, then I would say that these two are better options, because as you have equity in a side account, not trapped in the equity of your house, if you have something happen and you're out of work for 6 months or a year, you can tap into that money. You don't have to sell your house. So if you're in a down market, you don't have to sell the house. If you're in an up market, you don't have to sell the house. You can stay in the house and continue with those gains. So this is an investment strategy that I started to create, and I've been talking to a lot of financial planners about it, and they love this philosophy. So let me just again show you compound interest on a grand scale. So as we look at reverse mortgages, why does a client do a reverse mortgage? There's a lot of different reasons for this. One, they want to purchase a new home that fits their needs. They want to right size their home. Two, they want to postpone taking money out of investments to live. So right now, as the stock market's down a little bit, maybe they want to do a reverse mortgage and postpone pulling money out of the stock market, out of their retirement account. They want that money to grow a little bit more. Maybe they want to wait, instead of pulling money out of their Social Security or taking money at Social Security at 65, maybe they want to wait until 70 and they collect the maximum funds, or 63 to 65, whatever. And they collect more at 65 than 63. So, what do they want to do? They want to postpone taking money out of some investment to be able to live. They want to give an inheritance to their family now, opposed to later. At the end of the day, a reverse mortgage is a great loan to be able to sustain life in the home as long as possible, which is what we did for my parents. But most importantly, there's no mortgage payments on a reverse mortgage. So the mortgage payments are taken out of the equity of the house every single month. Now, a lot of times the kids get in the way, because the kids will say, well, that's my equity. That's my inheritance that you're taking money out of. Again, the reality is that the kids are going to pay one way or the other, where it's a monthly payment that they're going to help their parents live in the house for a while. So they're going to have to help them on a financial sense, or taken out of the equity of the house, which then, they don't need to take their money and give it to the kid or their parents to live on a monthly basis. So it can be a good, wise investment tool. So walk with me on this. Let's just say, hypothetically, and this is creating generational wealth. It's done one time, and then it will never need to be done again. It can be readjusted, but literally this can happen one time. So grandparents are 70 years old, and they have their house paid off. So we go in and do a reverse mortgage. Let's say the house is worth $400,000. At 70, we're going to be able to tap into around 50% of the equity. So we pull 50% of the equity out, and they have 4 grandkids. They take $50,000 and invest it into an account with each grandkid. So each grandkid gets $50,000. But of course, you're saying, Walt, that's crazy talk, because at 10 years old, that grandkid's going to start taking money out to go buy the bikes and games and whatever else they want to buy. And so what the grandparents do is they set it up in a trust. So they set it up with a financial planner, $50,000 in an account. but they put it in a trust with an attorney, and that kid cannot pull money out until they're 25. So at 25, they can pull money out, but they can't do it before that. And the only reason why they can pull money out,
There we go.
I don't know if you guys can see me still, but
Okay, I can see you. I can see you.
okay. So the only reason why they pull money out at 25 is to purchase a house. That's it. So they can pull $200,000 out of that account. That $50,000 over that 25-year period grows to $602,000. That's compound interest. That is what Albert Einstein was talking about with the eighth wonder of the world. So $50,000, this is at a 10% return following the S&P, at an investment of 25 years, grows to $602,000. So they take $200,000 out to buy a house 25 years later. Now they have $402,000 in an account. They have to keep that $402,000 in there because the trust states, now the grandkid has bought their house, but now they have to reinvest the rest. They have to keep it in there. They have to keep it in there for the next 40 years. So until they're 65. Now, who knows, even when Social Security goes bankrupt in the year 2035, how long they're going to bump Social Security out to where is it 70, 75, or 80 when we start collecting Social Security again? But ultimately, at 65, does this person even want to retire? But they can pull money out at 65 if they want to retire. That now, again, remember that they've taken that $602,000. They took $200,000 out, so they take $402,000 and reinvest it. This is the power of compound interest. If you take that $402,000 over a 10% return over 40 years, that grows to $21 million. So this can create generational wealth for a family. A massive amount. Now at 65, let's just say that person says, you know what, I can still work because everybody's living until they're 120 at that time. Who knows? It's 65 years down the road, right? So remember, every 7 years, per the rule of 72, roughly every 7 years, that money is going to grow and double. So let's just say at 65, they don't pull it out, but they keep working until they're 72. Well, now they're going to have 42 million. And let's just say at 72, they're like, you know what, I can still go. I'm strong. They go until 79. And now they're at 84 million. And it keeps growing and doubling and doubling. So that's compound interest. And that's one way to be able to help a reverse mortgage with families create generational wealth. So we do mortgage planning. We help clients with wise investing through financial planners, which then helps with wealth creation. So there we go. Any questions? You're muted. You're still muted.
I was muted. Sorry.
You were
I'm talking away.
Yep.
Someone has a question on whether you recommend a financial planner. Is there someone that you've been impressed with?
Yep. Yeah, I'll reach out to them individually. So
I would like that too. So reach out.
What's that?
Also. I would like a name of someone also.
Perfect. We're starting to work with more and more financial planners. And so we've been interviewing a lot of financial planners as of late, or I have been, as well as a lot of insurance agents, attorneys, and CPAs. So I've been doing a lot of that over the last month, and learning a lot of different financial strategies and that. And so, yeah, so I've got a good couple people.
Cool. All right. Okay. Well, that was another amazing class. Thank you so much. I've got everybody in, but send me the roster so I can look at the times, make sure everyone was on for the appropriate amount of time. And we will look for the next one. Do we have a date set up on our next one?
We do. I believe it is, let's see here. It is June 9th.
Okay. So hold tight until our next class, guys. We'll see you all.
I don't know what it's on yet, but it'll be on something, I hope. everybody wants.
We'll figure it out. Okay, awesome. Thank you. We're getting lots of good kudos in the chat. Yeah, I think everyone wants the name of your financial planner. So when we send out the recording and the notes from this class, maybe Walt can include that in there.
Yep, we'll do.
Okay.
All right, guys. Thank you so much. Thanks, Tracy.
Okay, bye.